Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for July 2024. We're putting this presentation together for our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. I'd like to start, as I always do, by welcoming our expert panel today, Joe and Paul. How are you going today, team?
Very good. Thanks, Chris. Good to be here.
Good, thanks, Chris. How you going, Paul?
Good, mate.
Now, it has been a very interesting month. We've had presidential assassination attempts. We've had someone drop out of the race, Bitcoin, gold, everything moving all over the place. Lots and lots to talk about this month. But before we get started, just the general disclaimer that we always provide, remembering that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Now, I've changed the format very slightly this month. We're sort of going to look at the big questions, where we are in the global macro cycle that we do every month, where we are in the global liquidity cycle, but then we're going to really dig into the other things that support or detract from that, and ultimately end up, as we do, determining how this applies to Bitcoin, gold, silver, and the GSR. So slightly different format, but all the same content is still in there. So if you're looking for it where you used to find it, it might be a slightly different spot in the video, but it'll all make sense as we go, hopefully. So we'll start off as we usually do with the biggest picture of all, which is the global macro cycle. Now, we've talked about this every month since we've started recording these, that we've had really no great takeoff just yet. I might start with you, Joe. Really, nothing seems to have changed that much. If anything, we've sort of dipped down recently, back down towards the lows, but we're still in mid-cycle. That could be confusing to people. What's your take?
Yeah, so as you pointed out, we haven't really moved very, very far in terms of where we are in the economic cycle the last couple of months. Some would argue that that's potentially a bad thing, people who are looking for a recession. But as we've argued the last couple of months that we've been on, this is indicating a somewhat sluggish economy in terms of growth. And sluggish generally for a government means that going forward, they'll want to stimulate. So we're actually looking at this indicator being a little bit low as quite a bullish indicator leading into the rest of the year.
And Paul, we are still, I mean, we've been saying this for a long time, second half. We've just crossed that sort of into the second half of the year point. And this is what markets do, right? It's not a straight line.
Yeah, absolutely. It's and you look for multiple cues as to where you're at, and we'll talk to that in terms of global liquidity, because ultimately, as we keep talking about, it's liquidity that leads these markets, and the liquidity is coming off a bumpy bottom, and that's in terms of the vertical axis of this chart. We're still well below that dotted line, but that also gives us courage and conviction that's where we're on the right side of it and on the trajectory up.
And it is a little bit unusual there for exactly the points you've raised, that often we would expect to see this mid-cycle on the other side of that line, but it's only, all signs are pointing to up. We'll look at that a little bit closer. You mentioned global liquidity, and that's the next big question. We believe, and we can prove it, and we talk about that as well, that global liquidity is driving the macro cycle. So when you look at this chart, which is a new one, Joe, I'll get you to talk about in a second, you can see it's a very consistent pattern where you have global liquidity driving either booms or busts.
Yeah, so this is a fantastic chart that you've created, Chris. So basically what it's showing is exactly that, the booms and busts. The green dots at the top are indicating a high in liquidity and the boom in the cycle. And then as that rolls over and liquidity is withdrawn from the system, you've got the relevant busts in each part of those cycles. So after the bust, of course, usually what happens is governments and central banks will want to stimulate, which will drive the next cycle. So you've actually indicated well-known market events in each of those booms and busts, just to sort of get people's imagination and recollection of where those when those events occurred in history. So it makes a lot of sense when you look at it from this point of view.
And that's right. And Paul, it's not everything, obviously. Like, we're not, everything is not captured on that chart, but it gives you some of the key highlights of what was happening at that time as a result of the fact that we had high liquidity going into the system, or that we had liquidity being drained out of the system. I mean, you've highlighted a few of these yourself when we were talking about it, that were really pivotal moments in history.
Yeah, and to my previous point, look where we are, right? So we are not late cycle by any means, and I guess part of that turn from early to mid cycle is the inflation piece, and we've come off, that previous green dot is COVID, which put all sorts of distorted pressures on prices, from supply constraints, logistics, that sort of thing. So we're not coming out of a vanilla inflationary environment even. So we can't expect this to be a smooth transition. But what we can see is that we're still way down there, and what we're going to see is the trajectory is right. So it gives us, pretty strong conviction that we're not looking at a market in a late cycle by any means, and clearly early in this one.
And the COVID example is a great one, because if you go all the way back to 1970, I mean, it's the highest dot. There was just so much unprecedented levels of liquidity. When you look back at some of these historical events, they were unprecedented at the time as well, right? Like they're very large amounts relative to the amount of liquidity in the system at the time. But COVID, blew them all out of the water, as you would expect as we move through history. But exactly to your point there, we don't know what the next green dot is going to be, but we know there will be some boom that it results, because the seeds are always planted through the previous red dot and the period that we've gone through. So pretty compelling when you look at it through that really zoomed out lens of what you can expect. I just put this slide in to highlight. We have gone in and provide a bit of detail around each of those points, so you can sort of go back through history and discover what was actually going on there. So you can find that if you sort of look around, we've got that up on X and other locations where you can really dig in and see the detail that was provided there. So there's more than just the dot. There's a little bit of elaboration around it. If that then takes us to Joe, and I'll ask you about this one, the Global Liquidity Index as it stands currently, sort of zooming in over the last 2 and a bit cycles, because we're not quite all of the previous cycle there. But we had the very clear up down COVID cycle, actually a relatively short cycle when you look at it historically, and then we look like we're dipping back down here. But sort of following on from what Paul said there, no real reason to panic here, because we don't expect this to stay low forever.
No, absolutely. And historically, central banks would have likely eased, and governments would have eased a bit earlier in this liquidity cycle than usual. But due to the inflationary period that we've just gone through in the last couple of years, due to the massive stimulus of COVID, they're a little bit more reluctant to stimulate when inflation is coming from the levels that it has, because they really don't want to stoke, which they probably will in the end of it, but they don't want to stoke the fires of inflation too early in this part of the cycle.
And we'll look at that in a bit more detail shortly, because they have been waiting for the exact reasons you said, and it's taken time. But I think we're possibly coming to the end of that. So we'll talk about that in a minute. But first of all, just this idea of what makes up global liquidity. We've talked about this before. I won't dwell on it. But you do have the important thing to recognize, that it's not just the central bank balance sheet. That's a big part of it. And that's what ultimately drives the mood or the sentiment of what everyone's going to do. But it's not just that. It's also things we talk about, collateral and overall other aspects in the private market that build together to give us that total number. But looking specifically at the central bank aspect of it, we've really had a chart here that's looking pretty good. Paul, we were talking about this just before. You've got pretty much mostly greens and yellows indicating a pretty good environment all around. So why is it that it's so sluggish when we've got mostly greens and yellows there?
Because they're all equally weighted there, but the reality is and I think as we said goodbye last time, I said just watch China, and China is definitely the biggest drag globally on this index. They're in a battle to try and protect the yuan, but they are in a increasingly sluggish environment. So they are still in that sort of reddish color, and you'll see that whole chunk of Europe is still in that, don't know what you'd call that, but just coming out of light red. They are still tightening. I mean, and again, the thing we've got to remember with that index, whilst it's pointing down, that's we had the trajectory piece, right? So still tightening, but tightening less. So we're getting that transition in Europe of dark red to now that yellow, but the elephant in the room is China, and but we are absolutely coming into a period where we're already starting to see some loosening out of those guys, and seasonally the second half of the year is when China tends to increase liquidity. So a lot of the drag that we've seen so far has been China, and they're still the biggest. I mean, we've got the red bar of Argentina, but that's the new president getting things sorted. So, but really most of it, as you say, is starting to go green.
And Joe, I know you've got lots to talk about there. I'm actually going to not ask you that question yet because we'll talk about it a little bit later. But China is definitely the focus that we need to be watching here because of that disproportionate weight that it has on it. Before we get to looking at China specifically, I want to spend a little bit of time on the US, because part of the reason we do that is that they by far are the biggest. We talk about China supporting that as probably being the second largest impact, but the US is the biggest, and we have just really great and reliable data out of the US. So we tend to look at that for cues. We looked at the growth side of this with the ISM data last month, and it was looking pretty good that we had sort of this services number looking quite well, and it really fell back down, giving us the overall sort of leading indicator just below the 50 line there. With the 3 month looking out, it looks like we can expect some recovery ahead. A lot of negative sentiment in the market around that number, where both manufacturing and the services came in below the 50. What was your take?
I think it's really a reflection of the first couple of charts we went through in terms of the economic cycle. If we're looking forward to the rest of the year and we expect liquidity to continue to rise, which we do, that will also drive the ISM manufacturing and servicing higher as well. Generally speaking, like as we've already mentioned, it's basically a basing pattern with a slightly sluggish economy and in slight contraction, and it's really just in my mind, it's the perfect scenario going forward to be in risk assets as the monetary and fiscal taps get turned on.
And you've made that point before. Why is that? Why is slightly below the line but not plummeting the ideal place to be?
I suppose if you're looking at the economy as a whole, and things are starting to, like, they have been slowing down for quite a period of time. It's not exactly falling off a cliff. So it's nearly as if it's been managed, I would say. If it's been managed, but going forward, the US policymakers want to actually create growth, then you need people to actually spend. And for people to spend, they need to have that wealth effect via either money in their pockets or via the wealth effect from higher asset prices.
Absolutely. So I can see a compelling argument there. We've got the tick up here as well in the leading indicator a little bit further out. So it's obviously not all negative. I know that you looked at this in a bit of detail at the time. That was the combination of sort of forward orders against inventory supplies. So it's not all dire when you zoom out that little bit further.
It's a very slow moving beast. I think we have mentioned this before. You look back at COVID and those large gyrations maybe throw the scale out a little bit in terms of what people's expectations are. But historically, the ISM in manufacturing and servicing it doesn't happen overnight, so it doesn't happen month to month.
And the trajectory is there, right? Again, the T word, it's
the direction of travel,
it's moving up. Yep.
And that was that basing out effect that Joe was talking about. Paul, Joe mentioned this before, and you talk about it a lot as well. The inflation side of the story, our leading indicator here is now below the 2% level. So, that's sort of always been the Fed line in the sand of what their target was. If we're seeing that down there, and I imagine the potential for the actual CPI numbers to fall to match that, they've been surprising to the downside consistently, and we've been arguing that they would be surprising to the downside consistently. Is this the fuel that's needed or the tool that's needed for the Fed to be able to actually start really ramping up their easing?
Yeah, because it's coinciding. The Fed have a twin mandate, right? It's inflation and jobs. So what they're looking at now is inflation steadying it around where they're comfortable. They're looking at those sluggish PMIs that we just looked at as well, but they're also looking at a deteriorating employment market. So they've kind of got all the ticks they need to actually start to drop rates, and the market's absolutely pricing that in almost fully for September. It'll be a surprise if it's July still. but you can see all the elements that they are building for that rate cut that everyone's waiting for.
And September's a long way out. I mean, you could theoretically see a scenario where you really just get a really bad employment print and some sort of emergency cut. I mean, that's probably a bit too wild speculation at this point. But a situation like that would certainly show everyone that it has changed. I mean, we can see that looking forward,
we've
but
got
not
to
everyone
remember
else can.
too. Yeah, sorry, Chris. We've got to remember too. The fixation on rates it's great from a sentiment point of view, obviously, but a lot of the situation we're in now with global liquidity is about refinancing, right? And that that doesn't care so much about rates. It's not discretionary. When you have to refinance, you have to refinance. So the rates is certainly a market sentiment factor, but when we're looking at that global liquidity, it is not waiting for the Fed to cut rates. We're seeing that happening already because it just needs to.
And it's a great segue into what we also look at, the debt side of it, because yields are, or the bond yields also play significantly into this. We've talked about this extensively. We look at that longer term chart. The red line shouldn't be above the other coloured lines there for a long period of time. When we zoom in a little bit on the last 5 years, we've seen stability here, certainly. I mean, I'll probably ask you about that, Joe, and then I'll probably come back to you as well, Paul. This idea that we were worried earlier back here that it could really start breaking up to the upside. It pulled back down. It's just sitting really sideways. Is that further evidence of what you were saying before, that the, let's in quotes, Goldilocks situation, where it's just not doing anything, but that's probably quite good for risk markets?
Yeah, so I think last time when we were on, we were sort of discussing that it was a bit of no man's land at that point. And when we're looking at the bond index or the move index, which is the volatility of bonds, being a major contributor to global liquidity in terms of its collateral, that's why we've seen a stabilization, even then a slight uptick in global liquidity. So we were a little bit unsure where it was going to go. I'm leaning more towards, from the evidence that we've already been through the last few charts, that we'll start seeing bonds rally and those yields start to come down. So as in that chart will start to move lower, and obviously that's going to improve collateral values and drive liquidity forward, drive liquidity up. So we probably cross-reference that with your Dixie chart that's coming up as well, or DXY.
Absolutely. Paul, if you look at this, we were concerned, like, what do you think? Well, we were concerned that there were two options, right? And both of them we thought ultimately were quite good for us. But we had the option where it really breaks out to the upside and we start to see the bond market, for lack of a better word, have a tantrum and get out of control, and the Fed and the Treasury forced to step in and implement some sort of yield curve control mechanism. You could argue they're already doing it under different names, but like really have to do it heavily. If it rolls over, the other option was that it rolls over here naturally. Probably that's driven by rates coming down, which is obviously a choice made by the Fed. But what's your take on this? Are those two options still at play?
It's wrong on a number of levels, right? The red line shouldn't be above there. The yield curve itself, you can see, is inverted as well, so that we've got negative term premia. That drop, for the red line to come down, that's over 100 basis points. No one's talking about, so September's 25. So there's still a lot of dislocation, and you can see, and part of it is you talk about sort of the yield control that's not yield control. Like the fiscal issuance has been so large in the bill, like in the short term. So it's just starving that 10-year market, and so we're getting this negative term premia between the various instruments, and then all of that is well below the Fed rate. So we either see that Fed rate plummet and come down and meet that market, or the only, as you said, the only scenario for up is some sort of market tantrum, and that has to be a loss of faith. So that could be whoever gets in November spooks the market, and then we get that sort of repeat of the gilt crisis where you get yields just rocketing out of lack of confidence in the issuer themselves. So on any account, either of those is magic for gold. But it's a real wait and see. And look at that brown line, nearly $35 trillion. But so there's plenty of reasons for a lack of confidence scenario, but you would expect they'll orchestrate a soft landing, and that red line will come down and meet, and we'll all say kumbaya.
And it's pretty clear that those yields have been managed, though, based on exactly what you're saying, Paul. It's like you've got the Fed funds rate there well above what the actual bonds themselves are yielding. And now we have spoken about this before in regards to the Treasury buyback program. The balance sheet runoff from the Fed, they've been reducing that, so that means they can sell less bonds in the market. They can refinance ones that they recoup their principal on, ones that expire, on bonds that expire. So yeah, it's clearly not a free market, and it's obviously, in my eyes, it's trading that way.
Well, and just coming back to a point that Paul raised about the gilts crisis, right? Like using the UK example, that was really the market having a tantrum over Liz Truss at the time, wanting to do something out of the ordinary. Do you, Paul, probably to you on this one, do you see a scenario where, well, we know it's not Biden now, like that was news this morning. So, Trump potentially, we know he's volatile, right? Like it could come out with a policy. I mean, I'm hearing rumors on X and other platforms that the people he would put in place probably know what they're doing. So we might not have that, but it feels like it could potentially, we could get that volatile situation depending on who gets in if the market just doesn't like it.
Yeah,
because that seemed to happen in the UK.
Joey just said it, right? This is orchestrated. This is completely orchestrated. So if the new conductor, right, doesn't play the game, then that's when you can get that real turmoil on the market. So and we know from the previous term we can get surprises out of Trump, and that could be one. So it's when something's not running naturally, you run the risk of that conductor mucking it up somehow.
So far so good, but we certainly need to be paying attention to that because the potential is there. But looking at this chart as it sits at the moment, it's pretty smooth sailing, and you would dare we say it, use those words, soft landing. It's really just playing out quite beautifully. It doesn't take much to upset that, but for the time being, another area that needs a bit more focus, I think, and Joe, I'll talk to you about this one, is the US dollar. We've potentially got here. I mean, we track it using this sort of cycle approach where we're in a sort of 6 monthly cycle for the dollar that it tends to fairly reliably repeat. We've come to the end of that. We still can't really pick what's going on. I mean, it's possible that we saw the start of a new cycle here. It was very early, topped out, and then we're heading much lower. Or it could be heading a whole lot higher. Now, the dollar provides either headwinds or tailwinds to global liquidity. Do you want to maybe have a brief talk about that, what the potential headwinds and tailwinds are, or how that operates, and then what you think is the most likely outcome here? Because I can't really pick one at the moment.
I'll firstly just explain what this chart is. So it's the DXY chart, which is basically the US dollars, the US dollar measured against the basket of foreign currencies. Most of about 55% of it's the euro. You've also got the British pound in there to a lesser extent, the Canadian dollar, and a couple of other ones, and the yen as well, which is around 10 or 11%. So basically, this is just relative strength against a basket of other currencies, which is and the reason why assets, for example, like Bitcoin and gold, have such a high inverse correlation to the DXY. So when you see that chart going up, that's putting pressure on the global financial system, generally speaking, because everyone, obviously, around the world, many countries have dollar-denominated debt. So as the US dollar strengthens against their own currency, they need more of their own currency to service the dollar debt, if that makes sense, because their currency is actually weaker. So if you're spending more of your currency to service your debts, and you've got less money to spend on other things, and it withdraws liquidity out of the system, which is usually for assets like that we're interested in, like Bitcoin and gold. It's generally a bad thing when the Dixie goes up, and is generally a good thing when the DXY goes down.
And I just want to pause you there, because that's a a distinction and an explanation that I haven't really heard a lot of other people saying. They identify that there's an inverse correlation, but they don't really understand why that exists. And you've laid that out quite simply to say it's a global liquidity story, right? Like ultimately, a falling US dollar relative to everything else is liquidity positive. So that's what sees a whole raft of new liquidity coming in. So it's not so much about the prices per se, it's about the extra liquidity and collateral that adds to the system when the US dollar is falling. I think that's a really important distinction to make.
And we need to remember too, when it breaks that correlation, it's generally when it's a flight to safety. So the US dollar is often also thought of as a safe haven. So when we get the flight to safety events, then you'll see gold and the US dollar go up together. But that's the exception.
And that's exactly what we've been seeing over the last 12 to 18 months, isn't it, with gold? Historically, if you were asked if the Fed funds rate was at 5.5%, you'd just say, well, gold's got to be lower, but it's not. Gold's significantly higher during that time of a stronger DXY. So in terms of Bitcoin, yes, it's still an excellent correlation, but you would argue that gold recently has varied from that correlation, and it varied to the upside.
Yeah, so that's not saying that the correlation has flipped. It's said you're saying that even though it was the US dollar was strengthening, particularly through this little period here, we still had gold pushing up to new highs on the back of the geopolitical of it doing its job, right? Like that's ultimately what gold's job is to protect against that uncertainty. But it's still going down, pushes it up further. It's not like all of a sudden now it going down means that the price of gold goes down. That's not what you're saying.
Yeah, it's exactly like Paul said. It's just a loss of faith. So in the system, effectively. So the US running such massive deficits, even with a stronger dollar, people are still losing faith in the dollar to an extent. So they're looking for alternative stores of value. Back to where you.
Yeah, that was my next question. So where do you think that's going then?
Well, in relation to the previous chart with the bond yields as well, they're closely correlated. So I would expect my base case at the moment is that without chopping sideways, well, if we may chop around for a little bit more sideways, but in the mid to long term, that trend's down.
And there's a lot of controversy on this, right? Like you've got widely varying views on that, and people making very compelling arguments both ways, saying that we will see more the US dollar milkshake theory, for example, saying much higher, but you can probably have all of that still be true. Like multiple things can be true at the same time, just on different timescales.
Yeah, 100%. It can still end up higher in the long term, in the longer term. So, but we're sort of I wouldn't say we're short term either, but in that midterm, 1 to 2 years, we expect that to trend down. That's for a number of reasons. Like you look at, like as we discussed, the US wanting to stimulate the economy, political pressures from Japan and other nations, for example, where their currencies are just getting absolutely hammered against the US dollar. So, we wouldn't be surprised if you start seeing some swap lines go through for those countries to help strengthen their currency against the US, help them with their dollar-denominated debt.
That all makes a lot of sense. Now, we also look at the weekly liquidity. This is just a zoom in aspect of it to see if it supports where we think we are in that cycle. We've had you talked about this at the time that we were having the air pocket. Then we sort of had a second air pocket. There were a number of factors causing that earlier in the year, because as you can see, this is all sort of through the sort of really Q2 mostly, that we saw that real volatility there. Relevant, we're obviously pointing up in the right direction. These are, of course, are raw numbers, so the actual dollar value of the global liquidity that exists. But I want to come back to something we talked about before, which is China. Having a closer look, I think this chart really stuck out to me. You've got China down here just massively appearing to drag on the market there. Paul, what's your sort of perspective on this relative to what we've seen up here? Is that why we're seeing that index really struggle?
Absolutely, and it's in part why that nominal arrow is heading up, whilst the index arrow is heading down at the moment. Is we're getting, and we've got to remember, central banks are only part of, as you said earlier, part of the liquidity play. So we're getting a lot of private money coming in off that stronger collateral market. But so China absolutely has been the drag, but there's already early data to suggest that they're reversing that right now. So, but what that tells you is the sheer scale of how quickly this liquidity could turn around and the scale that they could do it. So, so I think they're definitely still the one to watch. And as I mentioned earlier, seasonally, second half of the year is when they tend to do it. So we're right on cue as we sit here late July. So, so no, I'm very encouraged by that chart. And you see, look, second from the top, emerging markets ex China, are really pumping.
Well, that tells a story, doesn't it? Like that's massive. That you've got that the actual largest positive is the emerging markets. So they're doing well. It's just China that's really dragging them back.
Yeah, and you've got ECB up the top, right? So ECB are still effectively, in a negative number. The trajectory is up, but they are still balancing, inflation that isn't quite under control. So they're being very tentative. So the scale of where this could go is quite encouraging.
Joe, you've been looking at this really specifically. I just wanted to ask you, you were looking at this just this morning, some really, breaking news sort of stuff about what China was doing. Do you want to maybe give us a little bit more background about what you've been looking at with China?
So I'll just touch on one thing, exactly what Paul said just before. The ECB, in terms of it looking like they're easing, it's really just a basing effect, which is why it looks like they're easing. All it means is that they've actually, because this is a 6-month change, obviously, they were just so negative 6 months ago in terms of their pace of tightening that it just looks like they're starting to ease now. So really going forward, and it's the same for China as well. They've just been so tight for so long. Going forward, those numbers, that the ECB is sitting at 15. Like these are small numbers going forward, potentially for where global liquidity is actually going to go once all those numbers actually base out and start to turn the other way. In regards to China, I'm just having a quick look to make sure I get the exact numbers here. I think there was news this morning. Yeah, so China cut its repo rate by 10 basis points. So usually they follow up with the loan prime rate, which is effectively just, in simple terms, it's just easing of their markets and pumping liquidity into the system. So as Paul said, there's been signs for a few weeks now that we expect China to actually start easing just due to the economic troubles that they're having, or we've seen to have them. They've had 40 bank failures last week, I think it was, or something like that. So that's a fairly large indicator that they're in a little bit of strife there. But so going forward, seasonality, in not just China but the rest of the world, we've been saying it for ages. We've been saying it all year that the second half is probably going to be the part of the year where liquidity is going to be pumped in, and we're going to see the markets really take off.
And China's a perfect case study of what we talked about, even back in that chart where we were looking at the highs and lows over the, since the 1970s. You've got the seeds are planted at those lows. Now, China was working very hard to protect the yuan. That was why they were resistant. But at some point, they give up, right? Like they just go, well, we're just digging a hole. We have to be able to get out of the hole. We have to start doing something different. We could see that coming. And sometimes you just got to play the patience game and just wait for it, because we could see it coming, and we've been saying that for a little while. It is playing out. When you zoom out a little bit, people are always looking so closely. You zoom out, you go, well, really, a few months is not a long time in the big picture of this stuff.
And that's like all our charts. Everyone, some it sort of looks like it's been, you look back to our macro cycle charts or even our ISM and even liquidity. Sometimes it's just like grinding out the bottom. But when you zoom out, you're just looking at the general direction, because investing isn't a day-to-day thing or a week-to-week thing. It's a longer time horizon, and it's a bit of a slow game, and sometimes it's boring. But
you can argue too that the potential here too is part of why they don't. Part of why they want to try and control the yuan is they're worried about capital flight, right? So they're the biggest buyer of gold in the world. So if they're all of a sudden wanting to protect their wealth against a devaluing currency, what do you think they're going to do? So I actually think that this is not an oft talked about side effect for gold as well, is that they can increase that liquidity, but maybe domestically they start buying up gold even more so.
Even more so is the key words there, because they certainly have been buying big time for the last, for quite a while now, really. Perfect segue, really, to talk about how should you be allocated to Bitcoin, gold, silver. They're the things that we look at. I'll quickly go through before we get into the specific things there to say why we're looking at those three things. We've got, we've talked about this many times. Global liquidity leads world financial asset prices. It's not the other way around. There, that's the driving factor. We can prove that sort of statistically. There, we have our chart where we look at really gold and Bitcoin, highlighting the correlation that just exists with global liquidity. Global liquidity, more money in the system. Of course, those fixed quantity assets are going to go up. It's not really that difficult to get your head around that concept to go, yes, well, that makes sense. And we've also talked about this. That's why I'm just flying through them. But this idea of global liquidity correlation with Bitcoin specifically being very high, it's one of the highest correlations that exists. So when you've got the benefits of gold against that backdrop, makes a lot of sense to be looking at. Silver has a special role in there, which we'll talk about in a minute, but silver makes sense to be in there, and Bitcoin is almost tracking, or almost one-to-one tracking global liquidity as it comes into the system by its very nature. It makes sense for those to be the assets to focus on. Joe, you've referred to them in the past as, you back the fastest horse in the race type of stuff, that you go, well, there's pretty much everything responds to global liquidity at some level, but there's leads and lags, and it becomes complicated. But if we've got something that responds so highly to global liquidity, it allows us to take advantage of that and to trade it. I mean, we've got the Bitcoin chart here. We've seen it dip, but not necessarily so far. With what I've just said there, take us through your view at the moment on Bitcoin.
As you said, in terms of as I say, backing the fastest horse, it's important to actually acknowledge and realize what drives these asset prices. So we've identified that global liquidity is what drives these asset prices, which is why we personally believe there's a lot more upside for Bitcoin and gold as well. In terms of looking at that, so we've got the blue line, which is just the average price over the previous month. It's the way Bitcoin's trading today, it's actually pretty close, even though we've had a fairly big dip over the last 3 to 4 weeks. So that's brought the average. I'm not sure how it will show up next month, but it would probably be around there. We're back to trading about 67,000. But I suppose if you look at where liquidity has been over the last 3 or 4 months, and we've seen that consolidation of Bitcoin, it's held up surprisingly well in my opinion, and that could be. Occasionally we talk about the ETF, like demand from there, just ease of access for market participants to be able to buy this asset now. So, and that's potentially going to be a massive driver once again going forward, once liquidity starts to pick up throughout the second half of this year.
And we always have to remember that this would look like a very different chart back here during the time. It looks like a flat line now. That's the sheer magnitude of these lines really distorts what's going on. But certainly we had the lows correlated very well with the lows in the liquidity cycle, and ever since it's really taken off. And when you average it out, like you just mentioned, it looks quite smooth, when really it was a wild ride in the movement there if you were trading it day to day. But that's why sometimes you best not to do that. Looking a little bit closer at the daily signals, and we sort of follow this similarly to what we did with the dollar, but that was weekly. This is daily. We're in a new cycle here. We called that quite well, actually, expecting that to be the low, and it was. We're well and truly taking off into that as of today. Do you think that we're potentially a little bit overdone here for the next, like, if we are looking at that really short term view? Do you expect some sideways? Is it straight up into all time highs? Do we head back down and take out those lows? What's your view?
It's certainly been a significant rally off the bottom there. So I'm not sure if anyone who's watching followed along, but that last final dip capitulation is where a state in Germany sold about 50,000 Bitcoin, I think it was. So over the last, pretty much down to the bottom of that dip, they were selling, and there was also a lot of news headlines. So I suppose there was a lot of retail investors that really bought into that fear and also sold, which contributed to that final capitulation. So I actually think that's probably going to be the bottom. And when I say probably, I mean like a high likelihood. I can say with confidence that I think that's going to be the bottom. Now you're talking about the rally that we're currently in. That's a pretty solid move. So in terms of our 60-day cycle metric, it wouldn't surprise me if we don't break a new all-time high in this next 60 days. But potentially the 60 days after, it's lining up very nicely in terms of the macroeconomic and liquidity cycles for us to clear that $74,000 range.
So certainly we got there very quickly, and it might be due for a bit of a pause. But whichever way you look at it, it's looking very bullish that it has moved so significantly. And on relatively little news too. There hasn't been anything particularly driving it, just the usual drivers. It's not anything in particular.
Yeah, and I think it's important to reflect on that low as well. We had high conviction that, there's a lot of commentary that the Bitcoin cycle top is in, and I suppose people could still be saying that because we haven't seen a new high. But we stuck to our data and our metrics, and we said that's a buying opportunity, and so far it's been proven correct.
Absolutely. Turning from Bitcoin to gold, Paul, I'll talk to you about this. Really, this chart has just been absolutely beautiful. It's responded perfectly to the lows in the liquidity cycle. We've been up ever since. This bit, I get some sort of questions and commentary on X about, well, hang on, the liquidity cycle is diverging here. Is it diverging? To me, it looks like it's probably still following along. It's just based from a higher level due to geopolitical events and things that have been going on. Is that your take? Is it just doing its job? Or?
If you look at the direction of each time, it changes direction.
Yes.
The magnitude, certainly this year we've seen that relatively small uptick in liquidity from March, be quite exaggerated with gold. But as you say, we've had a number of other factors like central banks buying up at an incredible pace due to geopolitical issues. But I guess this chart reinforces too that whilst gold takes cues from the Global Liquidity Index, it will also take on that safe haven role that we talked about earlier. And you can see that in early 22 when it took the Ukraine bid just to get us through that. So gold will still have two masters in that sense, but certainly, look, it's taking all the cues from the direction of liquidity, and it's looking through it because it's a market that's probably more attuned to where it's going to end up. And we're certainly seeing that play out in the price.
And we consistently highlight that point, even ourselves personally in our trading, that you need that insurance protection. Obviously the appeal of big moves in Bitcoin is appealing, right? You see that big move, but you don't have that 5,000 years of insurance security backing it. So gold has that place there because it does respond that way in geopolitical events. So we can be right about the global liquidity. That doesn't change the fact that someone doesn't turn their head slightly enough, and all of a sudden we're facing a very different political dynamic. Gold would have responded hugely to that instantly. We don't know what other risk assets are going to do in that environment.
Yep.
Silver, similar story. Just again, a beautiful chart. What's going on here? What's the appeal? What's driving those prices to be really just maintaining the gains that they've made?
Yeah, look, and we've said it each of the last few this is earlier than normal for silver to be rallying like this. That it would normally, if we're going back to those business cycles, it's one that it normally rallies late in the cycle, so it's coming on earlier. It does take cues from gold, so it'll lag gold. If gold takes off, it'll rally afterwards. But it's certainly very encouraging that it's as strong as it is at the moment this early into the cycle. So it's there's other factors in terms of just the sheer scale of demand for green energy and electronics and that sort of thing as well. So as we go back to those PMIs, which are heading up, silver's got two hats. It's part monetary metal and it's part industrial metal. So it's probably responding as well to that improving economy side of things as well.
Well, you look at the amount of money that governments around the world are, the amount of money that's going to flow into renewable energies, and these markets are forward looking. So to me, from what building on what Paul said, it doesn't surprise me at all to see silver behaving in that manner, even against a strong dollar.
Yeah, and off a very low base, right? So that gold silver ratio, which you just beautifully put up right now, it's coming off a very high gold silver ratio, so a very low base for silver. So it's a rally that we've waited some time for, and I think we're about to see some pretty special things out of it over the next year or so.
Well, what's interesting, like looking at the latest, which isn't reflected on here yet when we get the averages for the month, but that gold silver ratio has actually been ticking back up again on geopolitical. Like there's a lot going on in the world right now.
Yep.
It makes sense that it's doing that, but silver's not really giving up those gains. So if that ratio is increasing, but silver remains at that high price, when it next falls over, you would see that as another potential, rocket fuel higher on the back of that. I mean, you said we've been waiting for a long time for this. The silver stackers around the place that really have been wanting to see this. It's kind of is unfolding perfectly.
Yeah, and we're having this discussion of 80 something GSR. In 2011 it was 30. So the where it can go is off the scale of that chart.
This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. So we just like to throw in really a bit of a plan for people who maybe are following along at home and want to take advantage of some of this, but need a bit of hand holding along the way. So we just have a very simple strategy, the buy low, sell high approach to Bitcoin in particular, because that's your higher risk reward opportunity there over that longer term. So really all we do is we identify the time where we're at the low in that liquidity cycle, build conviction around that. Then we buy and we hold until we get to the high of the liquidity cycle, build conviction around that, and then sell. So bringing up that chart we were looking at before, our low was in October 2022. We put our buy in January 2023, and we're holding that to this day because, as we've said throughout this, we don't think we're anywhere near that high in the liquidity cycle yet. How has that performed? Well, it was 17,179 back when we bought it. Currently, nearly 300%, so nearly 3 times your money taken. 368 days to get there, but at the moment we're talking nearly 200% annualized. It's a very very well performing trade for those who have been following that on since we put that on a little while ago, and we'll keep watching that each month as a little sort of thing to keep people interested and tracking how this works in the real world and with sort of a real trade. So that brings us to the end of the analysis, everything we've looked at today. Like to wrap up with sort of some final thoughts on where we are, where we're heading. Anything else you want to add? So I'll start with you, Joe.
So just reaffirming the importance of liquidity on financial markets, and that liquidity, the way we measure it being mostly a lot to do with how China works, how the Fed works, and how the collateral values in the bond market work as well. So they're really the three main drivers. And from what we can see at this point in time, we're really at a turning point, I think. And I know we're sort of putting this on repeat every month, but I really think the second half of this year is going to be fantastic for assets like gold, silver, and Bitcoin.
Paul?
Yeah, absolutely. And we have to remember too, when we extrapolate that to previous cycles, this could go well into next year as well. So it's so we're grinding through. We knew it would be a grind, and again, all eyes on China, I think, and God forbid a surprise July rate cut, but I think we can comfortably assume it's going to be September.
My sort of take on everything that's being said today, again, like you said, the second half of the year, we're there now, and still a lot of second half to go, but it starts to get a little bit exciting. What I'm really looking for is to see, probably in the next month's video or the next couple of months' video, that we really see that index start to pick up to follow the rest, which should be on the back of, as you've both highlighted, China. So lots to pay attention to there. But it's looking great. It's really going to plan as far as I can tell. It's never a straight line, but it seems to be going to plan. So very excited about that. Thanks everyone for watching our update for this month. Thanks to Joe and Paul for your contributions and analysis. Really appreciate those. We always value feedback and discussion, so you can follow me on X at Tipper Analytics to stay up to date or reach out. We'll be back in August with the next monthly update to reassess and identify what's changed. Until we chat again, good luck in the markets.